The average new car payment is $800 a month. That's insanity.
Car payments are a mantra of the middle class. Got to get out of the car payment business, kiddo, if you don't want to be broke your whole life.
Right now, Americans owe more than $1.7 trillion in car loans. That's more than what the country owes in student debt, and even bigger than the entire GDP of Australia. It's enough money to buy every home in New York City and still have billions left over. It's the result of a growing crisis that's been quietly building for years, one that millions of Americans are stuck in. Car debt in the US has soared nearly 70% over the last decade, far outpacing wage growth and even inflation. The car, once a proud symbol of freedom and independence, has now become a symbol of financial burden. So, how did we get trapped? And more importantly, how can you avoid it? First, let's talk about what a car means in America. It's more than just a machine, it's an identity. A shiny BMW says, "I've made it." A Tesla? "I'm ahead of the curve." Cars tap into our emotions, and that emotional connection is exactly what lenders and dealers use to exploit American. Today, the average new car loan sits around $41,700, with monthly payments nearing $745. Used cars? About $521 a month. Even leases are pushing close to $600. That's higher than rent in some cities. But it doesn't stop there. The average new car now costs over $47,000, which is nearly 70% of the median US household income. Still, people buy. Why? Because they're not just being sold a car, they're being sold a loan. Picture this. You walk into a dealership and find a $50,000 SUV. You put down 10%, that's $5,000, and finance the rest. The dealer gives you a 72-month loan at 7%. The monthly payment? Manageable at around $790. But over time, you're paying more than $57,000, with over $12,000 to interest alone. Stretch it to 84 months, and the total climbs past $63,000. Meanwhile, the car starts losing value the moment you drive it off the lot, 20% gone in the first year. In just a few years, you're stuck with negative equity, owing more than the car is worth. And that's become normal. So what's pushing car prices so high? A perfect storm. The pandemic wrecked global supply chains, making new vehicles scarce. Prices surged. Used cars followed suit. Then inflation pushed material costs up. Steel, rubber, microchips. Car makers loaded vehicles with fancy tech, sensors, screens, driver assist systems, and even the most basic models became expensive. Add rising interest rates thanks to the Federal Reserve's fight against inflation, and it's a financial disaster in the making. Auto loan rates now average over 7%. But here's the trick. Dealers no longer emphasize the full price of the car. They sell you on monthly payments. Just $790 a month, they say. Sounds affordable, right? But by stretching loans to 6 or 7 years, they hide the real cost. And if you still owe money on your old car, no problem. They'll roll that balance into your new loan. Now your $45,000 loan becomes a $50,000 one, and you're paying interest on a depreciating asset. That's how the negative equity cycle begins. A few years in, your car is worth less than what you owe. But you need a new one, so you trade it in, roll that leftover debt into another loan, and repeat the cycle. Some people end up with $70,000 or more in car debt over time, often for vehicles worth a fraction of that. Why do we keep falling for it? Because cars are emotional. They signal success, style, identity. Dealers know that. They use it. Add in a little urgency. This deal ends today, and boom, you sign the papers. But this isn't just a personal finance problem anymore. It's a national issue. Car debt now makes up nearly 9% of total US consumer debt, surpassing even student loans. Over 5% of these loans are 90+ days overdue, and the delinquency rate is rising fast. In just the first quarter of 2025, borrowers aged 18 to 49 took out $95.5 billion in new auto loans. Those over 50 added another $66 billion. For many Americans, there's no alternative. Public transit is unreliable or non-existent in many places. You need a car to get to work, so people take on massive debt, not because they want to, but because they have to. So what can you do to avoid the trap? Step 1. Never walk into a dealership without a pre-approved loan from a bank or credit union. It gives you power and protection. Step 2. Follow the 24-10 rule. Put down 20%. Finance for no more than 4 years. Keep your car payment under 10% of your monthly income. If you can't meet those numbers, the car is too expensive. Period. Consider buying used cars. A car loses most of its value in the first 3 years. Let someone else take that hit. Certified pre-owned vehicles often come with warranties and modern features at a huge discount. Also, don't just look at the loan payment. Think about total cost of ownership. Insurance, gas, repairs, depreciation, and interest. That $790 payment could really cost you over $1,100 per month when everything's factored in. And most importantly, don't buy based on emotion. A car isn't a reward or a lifestyle accessory, it's a tool. It should move you from point A to point B, safely, affordably, and reliably. Now, what if you're already stuck in the trap? If your credit's improved, refinance your loan. You could also sell the car, pay off the difference, and reset with a cheaper option. Downgrading can ease your monthly burden, even if it means carrying a small balance. If you're really struggling, tighten your budget and hammer away at the principal. And if there's no way out, voluntary repossession might be better than defaulting. It'll hit your credit, but sometimes damage control is the best move. There's a bit of good news. The car market may be cooling. Interest rates are expected to drop by a full percentage point by the end of 2025. Inventories are slowly returning. Used car prices are stabilizing. If your current ride still works, consider waiting 6 to 12 months. It could save you thousands. At the end of the day, the car isn't the real problem, the loan is. That shiny new ride might feel like a win, but the payments, insurance, and thousands in interest? That's your future being drained. Before you sign anything, do the math. Add your loan, insurance, gas, repairs, and depreciation. Ask yourself, is this really worth 15 to 20% of your income every month? If the answer is no, wait, regroup, and make a smarter move. Now we want to hear from you. Drop your car loan story in the comments, your payment, insurance, anything. Let's unpack this together. If this helped you think differently, give it a like, subscribe, and send it to someone who's car shopping this week. Drive smart, stay out of debt, and remember, cars can be replaced. Your financial freedom cannot.